Please, everybody, off your video, please. So I can control it from here. Off your video. Can you hear me?
Yes, sir.
Yes, sir.
We can hear you.
Yes, sir.
Yes, sir.
Yes, sir, I can hear you.
I can hear you,
We
sir.
are ready.
I'm good.
Right on.
Yes, sir, I'm ready. Yes, sir, I'm ready.
Didn't take as long as it took last time. As long as it took last time. So we'll be starting. Right.
Sorry, everybody mute your mic. Sorry.
Can you all see my screen?
Yes, sir.
Yes, sir.
Okay. We'll be starting now. Good evening, everyone. I hope we all got the material I sent earlier. So I'll be tweeting only this one. The other one, I expect you to take time out to read so that you understand the standard very well. I must tell you, this is one of the most important standards as regards for Sbr. Please, everybody mute. Don't let me mute everyone. No. I would like us to be interacting in the classroom. So, this is one of the most current standards. In fact, in the past 2-3 years, if I'm not mistaken, they have always repeated it. The worst they could do is that at least once in a year, that is one in the 2 diets, they will repeat it. They will usually ask questions on advice 9. So, and practically it's relevant because whoever this reporting, I've shared the YouTube link. Check the groups. Whoever deals with reporting, you have no choice. Most especially you work in a standard organizations, a PLC, a limited that has shareholders that have directors. You will definitely have to deal with it right now because it has to do with financial instruments, and it's something that is practical. So it's not something you can shy away from. So for that reason, I want to urge you to please pay attention. This class may not be able to offer you all that you need to know about it, but it's just an introduction. And in fact, I think I will try and find time and see if I can tweet 1 or 2 of these past questions in Excel and share with you later. I couldn't do that today. Sincerely, if I've been able to see a question before and I've been able to. So I would have loved to walk through the questions together here, but I didn't have that to do that. So now see that the class even started the 9 because I was busy with some other things. So let's dive right into it. Like I said, I must actually do this application. Advice 9 is one of the challenging standards. Why? Because it's a bit, I don't want to use complex, but it's sort of, yes, but as much as possible, this discussion, I will try and break it down as much as I could for you. But like I told you, this is just an introduction. If you read that material, you can see it's very huge, 188 pages. Very much, but that's the full content of that standard. You really enjoy it if you have the time to read it. If you could not do that, you can ask ChatGPT to summarize it for you. So the materials is in each of the book. I'll share it with you in the afternoon. So ChatGPT can help you to compress it, summarize it, so that you could be able to pick whatever is important. It's somewhat much when you take it with work. That's like a quarter of the whole textbook itself. So, but you find a way to compress it if you could not read, or if you can read all, wow, you really appreciate that. So that's one point. This standard is something you should know because they usually love to test you guys on it. Two is the fact that when it comes to standard, you should understand and appreciate the approach we have been taking you. I believe the other tutors too, when they are taking standard, that is, even if the question does not tell you, tell us the definition, tell us the measurement criteria, tell us the recognition criteria. That was why I deliberately chose this question. So this is the way they want to see it. Even if they don't ask about it, just give them that. Let them know that, oh, if you understand this, that's what they are most important. That is most important to them. Because many a time, the calculation aspect that is, you can always get by on that. Between me and you, if you are on the field, you can always get by. So, can you hear me now, Said Mohammed? Hope it's better now.
Yeah, hearing you clearly.
Maybe you can log. If you log out, yeah, you can join the YouTube. I'll send the YouTube link to all the groups. You can join the YouTube. So let's start so that we can actually. We have just 8 pages, but in those 8 pages, I will try and be explanatory. I will try and take time to break everything down so that you understand. Once you understand, unfortunately, I couldn't get my hand around 1 or 2 questions in the class question to practicalize what you are learning. But notwithstanding, you really appreciate it. So let's start. Okay. So we'll be talking about recognition, measurement of financial assets, measurement of financial liabilities, the recognition, the classification, impairment. So this, I'll see if I can get the other part, the part 2 of this article too. Even if after the lecture tonight, if I can share it with you, so that you get the full gist. I did not even notice it just part 1, so I would have loved to bring it along. So we could have it. Let me see if I can see, as we are dealing with this one. If I can get it, I'll share with you. So recognition of financial assets and liabilities. According to advice 9, financial instruments. A company recognizes a financial asset or a financial liability when the company becomes party to the contractual provisions of the instruments. I need to explain that. So what gives rise to company to be involved in financial instruments is when there is a contractual provisions that the company has signed with another company, with another entity. So that's the basis. So you cannot get involved in having to recognize financial instruments if you do not engage in a contract that brings them up. And for the sake of definition, financial instruments has to do with anything that gives you an obligation or that confers you to receive cash flow from an obligation another entity is owing you. That's to limit it to only assets and liabilities, but it also involves equities as well. So that's why I would love to get this. So That's why this is not complete. So with the other one, I think we should be able to see where equity comes in. Some people said they don't have the YouTube link. It's not working. Let me see what I can do about that. People are on YouTube now, and nobody said it's not working. Let me just confirm that. Oh, they don't have YouTube link. What happened? Sorry about that. Okay. To okay. So let's quickly get to it. Yes, I was trying to explain that a company recognizes a financial asset or a financial liability when the company becomes party to the contractual provisions of the instrument. That is, they sign the contracts that put them in a position that either owes or owes, either owns OWN or owes OWE. So whichever way it happens, so if you happen to get involved in a contract that makes you to own or owns, so you actually definitely automatically a party to financial instruments. So that's one thing. For instance, if a company receives a firm order for goods from a customer, it should delay recognition of the trade receivable until at least one of the parties has performed under the agreement. You remember your IFRS 15, right? That part of the 5 processes that must be complete before you recognize revenue. One of which is that, okay, the obligation has been performed by your own company, by your own entity. Then you can then recognize revenue, even if cash has not been received. So this is what this is referring to here too. So you cannot go ahead and just recognize that, yes, the other company has actually been involved with you contractually until you have been able to deliver the goods or whatever transactions that binds you, you have been able to deliver to that person. So that's when you then they will also sign by acknowledging that they have entered into a contract with you. This is also contained in IFRS 15 too. So when you are trying to recognize your revenue. So this is what this is referring to. I hope you are getting it. Like I said, as much as we have just pick this, I'll try to break it down. Are you with me?
Yes,
sir.
sir.
Yes, sir.
I want to be clear
Yes,
because
sir.
don't just this trouble. Okay, so this will normally be when the goods are shipped or delivered. You understand now? So in contrast, however, a forward contract or option is recognized on the commitment date if it falls within the scope of IFRS 9. So that's another that. So that does not any obligation to be performed. Rather, once you sign that contract for option or forward contract, then it becomes effective immediately. So, except for trade receivables, a company measures the financial asset or financial liability on initial recognition at its fair value, meaning that everything that has to do with asset or liability under financial instruments is measured at fair value. But when it is trade receivable, it's not practical. It doesn't make sense that you fair value your trade receivable. It doesn't make any sense at all. So you rather put whatever the amount due on the invoice to your customer, and that's what you recognize in your financial statements. So I hope we are still in line. Nothing is becoming ambiguous yet.
Yes, please.
Okay, so the treatment of transaction costs directly attributable to the acquisition of issue depends on the instrument measurement category. That means, is if you evaluate through OCI, that is other comprehensive income, FVOCI. Is if you evaluate through profit or loss, that is FVPTN, and PL, FVPTN there. If you evaluate at amortized costs. So either of these three, those are the options we have to determine the value of our financial instruments. So on the basis of that, it's practically demonstrated in this question. So I believe we should be able to flow since I've sent them forward earlier. So what's the measurement of financial assets? If it is financial assets, how do we measure it? A financial asset is measured at fair value through P or L. TPL. So the implication of this is that unless it is measured as amortized cost or at fair value through other comprehensive income. So the major way for you to measure assets, the most common way, let me put it that way, is you measure it through P or L. If it is financial asset, the best way, the most common way, the most rampant way to measure is through P or L. I will tell you the reason. Classification depends on both the company's business model for managing financial assets. That business model they will explain this, and the contractual cash flow characteristics of the financial assets. That will also be explained too. So, question one. In accordance with IFRS 9, what is meant by a company's business model? We now explain this here. According to IFRS 9, a company's business model refers to how an entity manages its financial assets in order to generate cash flow. Not only financial assets, financial instruments. That's the best way to put it. Yes, not only financial assets. That's what business model is all about. Those business models are the fair value through CI, through other comprehensive income, fair value through P or L, fair value through amortized costs. So that's what business model is all about. So it's not restricted to only financial assets, and you see that as we move on. It determines whether cash flows will result from collecting contractual cash flows, selling financial assets, or puts. That means if it is that we receive contractual cash flows, that is over time, that means there is a regular way for you to receive money because you have that in your custody as your assets. For instance, if you buy shares in a company, if you trade in the stock market, you are entitled to be receiving dividends every year, insofar they make profits and they declare dividend. So you are entitled to it. So that receipt that you're having is contractual cash flow. In the contract that is stated that you have that amount, not amount rather, you have a particular percentage in relation to their profit every year. Sometimes it may not be up to a year. If you deal with government bonds or treasury bills, it's not up to a year. Some is 3 months, some is 6 months, some is quarterly, and what happens like that. So it depends on that contractual cash flow. Contractual there means that what is signed in the agreement between the two parties. So cash flow is, they may use cash flow, meaning that it's not once, it's something that occurs on a regular basis. So I hope we are on the same page, and then your understanding is that we are moving on, because IFRS 9 could be complicated. I need to tell you that part. The first time I wanted to say I should try it, that should be 2020. 2023. That is, yes, I think November 2023. I deliberately went for election on it. The man knows it very well because the man is even part of the INP. those that set the standard globally. In the Nigerian, we work with EY. It's one of their partners there. At some point, I just left up because the man was very good, but with this standard. So I want to try and see if I can make it less complicated. So just let's follow suit. So it determines whether cash flows will be done for collecting contractual cash flows, selling financial assets or goods, and entity's business model is a matter of facts. So I've just told you what the business model is all about. We can move on, right? The financial asset is measured at amortized cost if any of the four. One, the financial asset is held within a business model whose objective is to hold financial assets in order to collect contractual cash flows. A good instance is what? Your treasury bills. Your treasury bills or government bonds. So that's a very good example of what you measure and amortize cost. So, and not only that, though, if it is held in order that you have regular cash flows for it, that qualifies it to be measured as amortized cost. Secondly, the contractual terms of the financial asset give rise on specified date to cash flows that are solely payments of principal and interest on the principal amount outstanding. That is, there will be a date that it will mature. Unlike your share, your stock. Your stock does not have a definite date of expiration. Rather, you can decide to sell it. Deciding to sell it is another way to look at how you measure it. So, but for amortized cost, it should be that you have regular income, regular receipt of cash. From it's you having it, and at the end of the day, you can have access to getting your principal back and the interest. I don't like using interest actually, but I don't have a choice. That's what I know it's all about. So a financial asset is now measured at fair value through other comprehensive income if the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. That is your stock. A very good instance is your stock. Take it or leave it. It's your stock. Because it's normal that you receive your dividends. So, and not only that, at the end of the day, you still have the right, you have the ability to sell it. Yes, you have the right. So within the time you have not sold it, you have the right to be receiving contractual cash flow regularly. And also, the contractual terms of the financial assets give rise on specific day of cash flow that are solely payment of principal interest on the principal amount outstanding. So it's not different from one. The only difference is that this one, you from day one, you know that you are holding it because you want to sell it. That other one, you don't need to sell. There is an expiry date for it. So such that if you hold your stock, your government bond, for instance, with the intention that you want to sell it later, but within the time it still will be, you are having your quarterly returns. I like to use returns student of interest. So quarterly returns, the one you receive every 3 months. Then within those periods, if you have it that way, then it's measured as fair value through other comprehensive income, not amortized cost, because you have the intention of selling. But if it is amortized cost, there will be a tenure for that particular security. So when the tenure expires, then you decide to get your principal and the amount you want. So A company can make an irrevocable election at initial recognition for investment in equity instruments to be measured as fair value to other corporation income if they are not held for trading. So, IFRS 9 contains an option to designate at initial recognition a financial asset as measured at fair value through PON if it will eliminate or significantly reduce an accounting mismatch. This can arise when measuring assets or liabilities or recognize the gains and losses on them on different bases. So, those are the ways to measure your financial assets. It could happen in any of the three, but it's mostly common to be measured at amortized costs because I just give you an example. If it is stock, then it's rather better measured at fair value to OCI. So if it is not measured as fair value to OCI or amortized cost, then automatically it's being measured as fair value to PON. So on question 2 now. On Wednesday 2007, the cycle loaned 9 million to a subsidiary. Note to a subsidiary. There was no loan agreement or repayment date or interest charged. However, there was an expectation that the amount will be repaid on demand. This type of event has previously occurred, and the loan repaid at 31st December 2007. The subsidiary could not repay the loan, but it was probable that repayment will occur by February 2028. Does the intercompany loan meet the conditions in IFRS 9 to be measured as amortized cost? Now, before we move further, do you understand why we have to consider it as being measured as amortized cost? Can somebody explain? Are we there?
With you, sir. We are here, sir.
You are not with me. Nobody answered you. And nobody explain why we want to measure it as amortized costs based on our explanation so far.
I think because they will pay interest and also pay the original principal maybe when the time is due. That's
Thank
why
you.
it's capped.
Thank you. So it's not out that you want to sell it. We are not measuring as to value to OCI because we are not planning to sell. If it is not involved selling, that means there is no expectation of gain or loss. That's what you should get clearly here. Amortized cost is that it is already a fixed interest will be received and the principal will be recouped. Received it. Don't let me use big English so that people will not get confused. Received. The principal and the interest will be received at a particular date. That's what amortized cost is all about. At a designated date, you get both principal and the reward or the interest. I hate using that word, but I don't have it. So that's the basis. So you should get it right. So for them considering it whether it's amortized cost, I don't know whether somebody has understood it now. Okay, so let's now move on. So, the explanation on it now. To classify a financial asset at amortized cost, IFRS 9 states that its contractual terms must give rise to cash flows on specified dates that are solely payment of principal and interest on the principal amount outstanding. Does this align with what I've explained?
Yes.
Yes, sir.
Yes, it does.
So these cash flows must be consistent. Only one person is answering me all this while. Others, how far?
So we are here. We are here, sir.
We are with you, sir.
I don't really understand.
Nobody say I don't even understand. Oh yeah.
Somebody too, I don't understand.
Where did you become confused? Where did you become confused? Which parts?
Yes, I don't understand this standard.
Wait now.
Standard is complicated from the beginning, I think. It doesn't like
Yeah?
that.
That's not a good
I
one.
don't know
Yes,
as
sir.
if
From the
speaking
beginning, it's
another language.
complicated. We don't even understand.
Right.
That's interesting. Okay. What do we do? What do we do now? Do you understand that when we are talking about IFRS 9, we are talking about financial instruments?
Yes, sir.
And what did I describe financial instrument as? What did I describe it as? How did I define it? I need those that said they don't understand to be answering me now.
You said that it has to be an asset in someone's hand and also be a liability in another party's hand. So that's what I understood about that part.
There is another part to it. Not finished. Oh yeah. There is another part that you have not mentioned, and I've mentioned it this night.
Maybe that's it.
Somebody help out.
Said it's based on contractual agreement.
You go, as you mentioned, asset mentioned liability, there is third part to it. Nobody should help out.
You said it can be, you can be owned. You can own and you can own.
It can also.
Okay, the equity part.
You said?
So I think the equity part.
Yes, it could be an equity too. I mentioned that now. It could be an equity. It's not restricted to only asset or liability.
Okay, can I say something?
Go on.
A financial assets can be, let me just say, go on, understood. Any assets, it can be cash, it can be an equity instrument of other entity. It can be a contractual right to receive cash or another financial asset from another entity.
That is when it's an asset. It could be a liability too.
Yeah, it could be a liability when a contractual obligation to deliver cash or other financial assets to other entity. It can be obligation also to exchange financial instruments with another entity.
That's when it's an equity.
Yes.
Nice. Yes. So, and I try to give examples so that we will be on the same page. Having broken it down, thank you, Faith. Having broken it down, I don't know whether those that said did not understand are beginning to understand. You need to move forward, not understanding at all to a better level now. Are you now understanding small?
Yes, sir. Thank you, Faith.
Yes, sir.
Thank you.
Okay. So I now said that, okay, when it now comes to these financial instruments, there are three business models to adopt. You have option of adopting any of the three business, but it depends on how you classify your assets and the characteristics that surround the asset or liability or equity. How? I said, okay, if for instance you have it that asset, let me start with asset. That asset you only plan to let it be with you to earn you interest till a particular date, and at that date you now get your principal back and the interest. Then it is measured at amortized cost. So for the fact that you hold it, in order that you receive a contractual inflow, cash contractual inflow or contractual cash, then you are now receiving it at a specified date plus your principal. Meaning that the only thing you need to understand here is that it's not held for you to sell. If you are not selling it, then it's purely going to be measured at amortized costs. And not only that, you are not getting to equity yet. So let's still this where we have. Don't start confusing things. So meaning that you have from the day one, that's why I said it's the way you define it, the way the structure, the characteristics you give to it. So if it is designed that, okay, you are not going to sell, you are not going to make money, not just selling, let me put it straight. You are not planning to make money, like you want to make profits. There is a difference between you collecting interest and also making profit out of it. That profit may be a loss, so it depends on the time you take it to the market and what the value is, the fair value of it as at that time against when you buy it. So that's another thing entirely. But what we want to consider is that, are you planning to sell? If you are planning to sell, then it's no more going to be measured at amortized costs. It's either going to be measured as other comprehensive income or through P or L. I don't know whether this is explanatory enough.
Yes, yes.
Those that said did not understand before, I need them to respond.
Yes, I understand.
Right on, sir.
Okay. So by now, if you have a question in the exam that you need to now identify whether it is amortized or not, first understand amortized cost. That one is very clear. I'm moving on to fair value through other comprehensive income now. Now, when it is fair value through other comprehensive income, the first thing you need to look out for is that it is usually held for you to sell. Because you are looking, other comprehensive income, that means you are making money out of it. Then, not only just making money here, you are looking out for whether it's going to earn you profits or loss. It could be loss. I can bear witness to that because I handled the financial reporting of my company. So we do reports, fair value gain or loss. We do report it. It still happened last year, report it happened this year too. It's a normal thing. And it depends on, okay, when we now decide to sell that particular asset, do we make profit, do we make loss? So that's we base it on whether you are selling it or not. So if it is going to be sold, then you need to consider it to be measured through other comprehensive income. When it is now not measured through OCI or amortized cost, then it's measured as pure head. And that's part of what I've been explained here as well. So we now have a question that says that on 1 June 2007, the Synco loaned 9 million to a subsidiary. There was no loan agreement or repayment date or interest charge. However, there was an expectation that the amount will be repaid on demand. This type of event has previously occurred, and the loan repaid at 31 December 2007. The subsidiary could not repay the loan, but it was probable that the payment would occur by February 2028. What they want to even note here is that, okay, this case now, is it proper? Is it appropriate that, yes, does it really meet the condition in IFRS 9 to be measured at amortized costs? So this is the explanation. So I really want to get the background before I delve into the explanation. I hope everybody is on the same page with us.
Yes, sir.
Yes, sir.
Yes,
Thank
sir.
God.
Yes, sir. Yes, sir.
Thank God. Better. So to classify a financial asset as amortized cost, IFRS 9 states that its contractual terms must give rise to cash flows on specified dates that are solely payment of principal and interest on the principal amount outstanding. So that means you are not holding it for you to sell. This cash flows must be consistent with normal lending arrangements. As the intercompany loan can be called at any time, there is an argument that a financial institution will charge low interest for such a loan as it will be called in at any time. That's not an issue for us to know. What we want to know is that, okay, is there a specific date that you can get this amount back plus the interest on it? Thus, it could be argued that there is nothing different to a normal lending agreement with the current terms. Therefore, the intercompany loan meets the contractual cash flow characteristics test in IFRS 9. Please, let me say money like you want to make profit. Who is talking though? Is person talking to us? So let me say this.
Hello, sir.
Yes.
Sorry, sir. I want to paint a scenario to understand if, to be able to get what you are saying. You know, for example, now for government bonds, there are some people that buy those bonds, and when they buy from primary market, some decide to wait till the maturity date to get their interest and their principal back. So I think, is it this one that we can say is at amortized cost? And there's another set of people.
That one, you have gotten it rightly. That's what we are trying to explain. You get it right.
Because there is another set of people that when they buy the bond, they will sell it on secondary market to make profit, or in the process they might either make profit or make loss. So I don't know if,
you are right. Yes.
Okay.
Yes. So if they now have option of either selling or holding, in order to they usually, this is if you want to, if it is not the one you just described, the second one is through OCI, but it could now turn to profit or loss if there is an option for the one that it will be sold to make profit, and there is usually cash flow being received too on regular basis. It's a different one from you get the old money at the end of the maturity date. This one, there is a regular inflow.
Okay.
There is a regular inflow on it. So, and on that basis, you still have the option whether to sell or not. So if it is that, then it will be measured at through POL. But the first two is the one you should focus on, because once you understand the first two, if it is now not measured through amortized or OCI, then automatically it's POL.
All right.
Thank you. So therefore, the intercompany loan meets the contractual cash flow characteristics. Okay, to be measured at amortized cost, the instrument must be held within a business model that has the objective to hold financial assets to collect contractual cash flows. The loan is not held to sell, you can see. Therefore, the intercompany loan meets both the IFRS 9 test to be measured at amortized cost. So I want to believe with this analysis, we should be able to understand financial assets and how to measure them. Now we are moving to financial liabilities. This question, I must tell you, is from it's not a question per se, but it's in another illustration from ACCA. So those that said question for them, is one of them is one that drafted this. So it's more explanatory. You can see they like to be more illustrative. Let me put it that way. So if it is our own way of treating this standard now, you just be hearing. That's that one that I share with you. our home. So just be saying what is English all about. But they love to put it in perspective and then let you see the practicality of what they are talking about. So measurement of financial liabilities. Measurement of financial liabilities is easier than financial assets. Yes. Listen to this one and underline it in your own material. Almost all financial liabilities are measured at amortized costs, meaning that an interest expense is reported in the financial category of the statement of profit or loss based on the effective rate of interest. Financial liabilities held for trading, including derivative liabilities, are measured at fair value through P/L, not through OCI. The difference is that, okay, if it is liability, don't even talk about OCI. It is either amortized or to P/L. It will only be to P/L if it is held for trading, which we have talked about the other time. For assets, you will through other comprehensive income, mostly. So for liability, consider amortized cost first. Then, if it is now held for trading, then you consider it as being held for true or pure health. Do you understand before I move away from this one?
Yes, sir, I understand.
Okay. I don't think we have any dissecting for it there. Okay, thank you. So as with financial assets, a company can designate at initial recognition a financial liability to be measured at fair value through P/L. You can see if it will eliminate or significantly reduce an accounting mismatch, because the reason why this is very important and you should understand this is the fact that you need to come up with your business model before you recognize that liability or assets. It's very important because there is what we call consistency in financial reporting according to the financial concepts. In fact, there are three fundamentals of financial reporting, or what do we call it? So, or accounting. One of which is consistency. You cannot decide to change your policies anyhow. No, it's not allowed at all. It distorts comparison, it distorts accuracy, it distorts a lot of things. Organization is also part of what is required. So you can't just change anyhow. So that's why you need to decide before you recognize it. The financial ability to measure a fair value through P/L, if it will eliminate or significantly reduce an accounting mismatch, you need to determine that above beforehand. Where a company has a financial liability that is measured as fair value through P/L, the fair value of the liability can depend on the credit worthiness of the company. This one, I need us to take it slow to understand. They now painted a scenario. As a result, where the credit worthiness of the company deteriorates, the fair value of the liability will typically reduce, resulting in a fair value gain. Let me explain. You are owing somebody $500,000 or naira. Let me not disturb us. 500,000 naira. And you have to pay back with the capital and interest at a specified date. But if it is in your plan that you want to sell this loan, maybe it's a very attractive company that you are owning, you want to sell it to another person so that you can even get above what you are meant to pay that person back. If that is the case, what you have to do is that you have to recognize it as fair value to P/L because you have the intention of selling. Now, before you now decide what you want to, are we together? Who is that? Put your mic. So before you now decide that okay, you want to sell, you want to make profit and all that. Remember, it's a loan. So for people to buy it from you, it depends on the company that you are owning. She goes, you are disturbing us.
Inactive.
So you need to consider the company that you actually want to sell it to, rather, not the company that you are with. Company you want to sell it to. If the company is a fair credit body company, then you can sell it for a higher amount because you know they will pay if they agree to that. But if you know the company is not credit worthy, but you better sell it for lower amount so that you'll be able to get your money back, get the money back, and you not make gain, or you even sell it for less than the face value of that loan. So here you need to consider the company you are getting involved with. So insofar you want to sell, then it's involved fair value to pure or liabilities. So and where the credit worthiness of the company improves, the fair value of the liability will typically increase, resulting in a fair value loss. Look at how it is treated. Let me read that again. As a result, where the credit worthiness of the company deteriorates, the fair value of the liability will typically reduce, resulting in fair value gain. Why? Because they must work in opposites. Gain to you because you are paying less than the amount you are owing. You get it now. Because your loss, your liabilities has reduced, automatically you have a gain. That's what that is all about. And if your liability increases, that means you have a loss. So IFRS 9 requires the fair value movement in the financial liability designated to be measured as fair value through P&L that are attributable to changes in the credit risk of that liability should be presented in other comprehensive income as opposed to be presented in profit or loss. This does not apply where this treatment will create or will enlarge and accounting mismatch. So there is a provision in IFRS 9 that you should rather let it be captured under 2 OCI. But if you are able to convince yourself that you don't want a mismatch, then you can go on and adjust to your head, as the case may be. So hope you are still on the same page.
We are following you, sir.
Sorry, sir. Can you come again, briefly?
And see this one that I just mentioned, the issue of liability.
Yes, sir.
Okay, I mentioned that when it comes to liability, most liability are meant to be measured at amortized cost, just like we have for assets too. Because you are only looking up to paying back the amount owed plus the interest at the specified dates. And I've said that this will change if you have the plan to sell that particular liability. Then it will be measured at fair value through P or L.
Okay, sir. Thank you.
And I also mentioned that, okay, IFRS 9 made provision that it could be measured at 2 other comprehensive income, if and only if it will not result in a mismatch. So I hope we can go on now. Question 3. INSATCO has applied the fair value option in IFRS 9 in order that the recognition of gains and losses on the investment properties and related financial liability would be consistent, you can see. The investment property was measured as the fair value in accordance with IAS 40 investment property using the discounted cash flow techniques. Can INSATCO apply the fair value option rule in IFRS 9 to the measurement of its financial liability? Let's go. IFRS 9 allows companies to segregate the financial liability as measured at to fair value through profit or loss. If it will eliminate or significantly reduce the measurement or recognition inconsistency, in accounting mismatch, which will otherwise arise from measuring assets or liabilities or recognizing the gains and losses on them on different bases. This is an accounting policy choice. So, like I said, you just need to decide based on your intention. So, based on your intention, that's what will guide you in determining whether you choose to fair value to free or hell or two other comprehensive income. But mostly, like I told you, once you are not measuring it at amortized cost for liability, the best next available option is fair value through P or L most of the time. So, if the fair value option was not used, then the financial liability will be measured at amortized cost, you can see, and the investment property at fair value. However, there is significant correlation between the measurement of the fair value of the investment property and the related financial liability, in that both elements will use current interest rates. Therefore, the fair value option can be used to avoid inconsistency. So, once you use fair value approach, then you don't need to be bothered about whether the interest rate you use is the correct one. Because what determines the fair value will have considered all those factors ordinarily. Are we clear? I'm moving on to something else, which is something you should pay attention to. So the recognition. This is the removal of all or part of an asset or liability from the statement of financial position. We want to recognize it. We want to take it away from our reports or financial statements. So that's what the recognition is all about. How do we recognize financial assets? A company recognizes a financial asset when the contractual right to the cash flows from the asset have expired. One, that's one point. You should notice it that way. Or it transfers the financial assets such that it qualifies for recognition. Once you don't have possession, you don't have ownership of that financial asset, then you can't recognize it as yours again. A company transfers a financial asset where it transfers the contractual right to receive the cash flow of the financial asset, or where it retains the contractual right to receive the cash flows of the financial asset, but assumes the contractual obligation again to pay the cash flows to a third party. Somebody is owing you to the tune of 300 million. So you now decide that and that attracts interest. So you now decide that, okay, what I will do is I want to sell this. I don't want to have anything to do with this money again. Once you sell it, and you are the one that still collects it, that second part is the one that can be confusing. You are the one that still collects money from the person who you, but you have sold it. You have sold it. Then you have to remit it back to the owner, the person you are owing. But if you take yourself out of the picture too, and you recognize it, that's the best. So a company transfers a financial asset where it transfers the contractual right to receive the cash flow, or where it retains the contractual right to receive the cash flow of the but assumes a contractual obligation to pay the cash flows to a third party. So when you are still in control of, okay, I'm the one you are owing. But when you pay me, I take the money and go and pay another person, then that implies that I've already recognized it in my book. The company also evaluates the extent to which it retains the risk and reward of ownership of the financial assets. On the recognition of a financial asset, the difference between the carrying amount and the consideration received is recognized in the investing category of the statement of profit or loss. If a company neither transfers nor retains substantially all the risk and rewards of ownership of the transferred asset and retains control of the transfer asset, the company continues to recognize the transfer asset to the extent of its continuing involvement. The recognition of financial liabilities. A company should recognize a financial liability from a statement of profit or financial position when the obligation is discharged. When you have paid for it, you have cancelled it based on disagreement between you and the other person, or the time for you to pay it has lapsed, so it has been closed. So, an exchange between an existing borrower and lender of debt instruments with substantially different terms is accounted for as extinguishing the original financial liability and recognition of a new financial liability. Similarly, a substantial modification of the terms of the existing financial is accounted for by extinguishing the original financial liability and recognizing the new financial liability. What are they saying here? Is that somebody who and then always paid back in terms of interest and paid back. For whatever reason, that has to change. Then, if that happens, that it has to change, the rates of interest paid has to be reduced, for instance. Then that has altered the content of the contract. So the contract cannot be completed in that manner. So that's what they are saying. That means you need to operate with a new contract that specifies the current rates of paying back. The terms are substantially different if the present value of the cash flows under the new terms, including any fees paid, not net of any fees received. When discounted, using the original effective rate is at least 10% different from the present value of the remaining cash flows of the original financial liability. So 10% is what you look out for. If it is more than that, then you need to call attention as soon as possible. The difference between the carrying amount of financial liability extinguished or transferred to another matter and the condition is paid is recognized in the same category of the statement of profit or loss. So, I hope that is explanatory. Where the terms are not substantially different, the original is not recognized. The liability is stated to the present value of the revised cash flow. Any increase or decrease in carrying amount is presented in the financing category of the statement of profit or loss. Now, let's look at another person. On 31 December 2027, PUCO modified the terms of its long-term loans such that the effective interest rate changed by 10%. This question is very, very important. As a result, the present value of the remaining outstanding was reduced by 25%. What's the correct accounting treatment of the above? Now, let's start. The interest rate is substantially different from the original borrowing agreement, and the discounted present value of the cash flows under the new terms is more than 10%. Different from the original financial loans. This means there has been a substantial modification of the terms of the existing financial liabilities. The original financial liabilities should be recognized and new financial liability recognized. So this is what we are talking about, as I have mentioned. The difference between the carrying amount of the original liabilities that were extinguished, that means it has become concluded. It has actually lapsed its period. And the fair value of the new liability should be shown in the financial category of statement of profit or loss. So it's just the same thing we are talking about. We recognize the first one and recognize the new one based on the agreement. Now, The classification too depends on the type of model you are adopting. And when you are adopting a classification, it should be applied through prospectively, not regressively. So it's not that you take it from the previous years. No. You just take it off from that year going forward. That's what they are talking about. When you classify. Impairments, that's what we call ECL. For those that things in the financial instruments, you have heard of ECL, expected credit losses. So that's where the impairments, I think I've mentioned impairments several here, though we have not treated impairments as a topic, but we get there. So that's the summary of this impairment and all that's it's all about. So at this point, I don't know. Let's see if we have questions. I will see what I can do with past questions and see if I can solve at least one or two and then I'll share with you guys. Oh yeah, Stella, go on.
Yes, sir. Good evening, sir.
Good evening.
Please, there was something you explained about you said you ended it with provided that the accounting record is not mismatched. That term mismatched, please. What is it trying to explain there?
Mismatch means that it does not align with. Okay, let me say for instance now. It is captured as measured through OCI, other comprehensive income. You know, when we say other comprehensive income, it means that items below the line, that means the profit or loss has been determined. Those items that will fall below them because they can be reclassified to profit or loss later, depending. So if you did not do your analysis thoroughly and you go and classify it under OCI, we realize it's supposed to be profit or loss. That will be a problem. Because the conditions that made them to stay in that line, you did not fulfill it. So that's what mismatch is all about. And if you go and do it as amortized cost too, if the condition, the way we explain amortized cost, if that is not the basis of your own choosing it that way, you get it wrong. So that's what mismatch is talking about. Partly. Another way you can have mismatch is that you ought to recognize the gain because you actually sell and you actually make gain. But you go and recognize that as your interest. They are two different things. They are both income, but the way you classify them, it has distorted it. There is a mismatch. So, I don't know if I get it. Any other one?
No.
Others, no question. Okay, if there is none, so thanks for the class. I think I want to call it a day now.
Thank you, sir.
Sorry, sir, can you please
Thank
send the
you,
material
sir.
again? Some of us were not able to access it.
Thank you,
You
sir.
said?
Sir, please, can you send the material again? Some of us were not able to have access to it. I just joined the group today, so I didn't find the material.
Really? Okay, I will send it. No problem.
Thank you very much, sir. Thank you, sir.
You're welcome.
Thank you, sir. Good night, sir.
Good night.